Okay, we are now going to look at the science of term structure. The emphasis of this topic is pricing interest rate derivative using a risk-neutral binomial method. The pricing process for interest rate derivative requires intense calculation. It is very tedious. However, the relationship becomes straightforward when it is modeled to support risk neutrality. Understanding the concept of backward induction and how addition of time steps will increase the accuracy of any bond pricing models. Bonds with embedded options are also discussed in the topic. Be familiar with the price relationship for both callable and puttable bonds. This topic incorporates elements of materials that we studied in the FRM part 1. Let's look at interest rate model. Now we are required to calculate the expected discount value of a zero coupon security using a binomial tree. Construct and apply arbitrage argument to price a call on a zero coupon security using replicator portfolio. Explain the role of upstate and downstate probability in the evaluation of call option and a zero price security. Now the binomial interest rate model is used throughout the topic to illustrate issues that must be considered when valuing bond with an embedded option. Binomial model is model that assumes that interest rate can take only two possible paths in the next period. The interest rate models take assumption about interest rate volatility along the set of the path that increases that interest rate may follow over time. This set of possible interest rate path is referred to as interest rate tree. Now a tree will start with two branches and then two branches and so on. So it would be today period 1, period 2. To understand a two period tree, if we consider nodes indicated within the boxes, a node is a point in time where interest rate can take two possible paths, up or down. Now consider a node on the right hand side as we move ahead. This is the rate that will occur if the rate IO follow path from 0 to 1, then follows path two possible paths, and at the end of the observation the upper path forms a given nodes lead to a higher rate than lower path. Now an upper move is move followed by a downward move gets us to a same place where a down and an up move. So we will combine both of them. The interest rate at each node is the interest rate. Trees are one period forward rates corresponding to the nodal period. Beyond the root of the trees there is more than one period forward rate for each nodal period. That is year 1 we have 1 year forward rates. The relationship among the interest rate associated with individual nodal period is a function of interest rate volatility assumption of the model being employed to generate trees. The next heading says construct the binomial interest rate trees. The construction of an interest rate tree binomial otherwise is a tedious process. In the practice, interest is usually generated in specialized computer software. The values for on the run issues are generated using interest rate trees should prohibit arbitrage opportunity. This means the value of the run securities priced by interest tree must be equal to the market price. This should be noted that while accomplishing the interest rate trees must equal the interest rate volatility assumption for the underlying model. Now valuing an option free bond using interest rate tree using backward induction. Backward induction refers to the process of valuing a bond using binomial interest rate trees. The term backward is used because in order to determine the value of a bond at node 0 you need to know the price at node 1. But to determine the value of node 1 you must know the possible values at node 2 and so on. Thus the following thus for a bond, the n compounding period, the current value of a bond is determined by computing the bond's possible value at n and working backwards at node 0. If we consider a binomial tree and if it's 100 face value 0 coupon bond with 2-year maturity and its market price is like suppose 90.006, starting on the top line the bottom at the each node includes the value of the bond. So after 2 years the value of the bond is 100 because that's face value, and there could be different values. So if today the interest rate is 4.5749 and it could go to 7.18 and it could go to 5.32 and then and so on. So the value of the bond at given node of the binomial tree is the average of present value of two possible values from the next period. So let's look at it. Now when we look at the price of the upper node, it should be like taking the coupon rate, taking both of the bonds and bringing it down to today's price. So if after 2 years whether it moves up or down, and there is a 50-50 probability, and we have to discount it with the price that could be there for between 1 to 2 years. then the same thing we are going to do, and we are going to bring it down to from 2 to 1 year using the other interest rate that could be there for the 1 to 2 year period. When we have bought both of them at a point, then we'll bring that value from back to our current period, and we'll assume that there is a 50% probability of going to both of these things. Now this interest rate is given to us, the up and down part, and we don't have to worry about that. Now I have assumed that this is a zero coupon bond. If there are coupon, you have to assume the coupon as well. Now let's look at things ahead. Explain why a call option on a zero coupon bond cannot be properly priced using expected discount values. Define risk neutral pricing and explain how it is used in option pricing. Explain the difference between true and risk neutral probabilities and apply the difference to interest rate drift. Now 0.5% probability was taken from up and down because it is assumed to be true probability of price movement. However, we have to make sure that we use risk neutral probabilities. Any difference between risk neutral probabilities is referred to as interest rate drift. Now using the risk neutral interest rate tree. Now there are actually two ways to compute a bond and bond derivative using binomial model. These techniques are known as risk neutral pricing. The first method is start with the spot and forward derived from the current yield and then adjust the interest rate on the part so that the bond we derived is equal to the current price of on the run, and this is known as an arbitrage tree. This is the model we used in the example. Once the interest rate is derived from an on the run, we use to price derivative security by calculating expected discount for each value using nodal. The second method is to take rates on a given and then adjust probabilities. So we'll first take the rates on the tree and then adjust probability so that the value of derived is equal to the current market price. Once the derived these risk neutral probabilities, we can use them to price derivative on the expected discount at each node using risk neutral probabilities. So remember the word here. It's a risk neutral probability versus arbitrage free, and these are the two methods. Okay, explain how the principle of arbitrage pricing of derivative fixed income can be extended to multiple periods. Now let's look at an example here. Now there are three basic steps to valuing on a fixed income using a binomial tree. We have to price the bond price at each node using projected interest rate, calculate intrinsic value of derivative at each node, calculate the expecting discount values of each node using the risk neutral probabilities, and working backward through the tree. Note that the option cannot be properly priced. Note that the option cannot probably using expected discount values become the call option values depend on the path of the interest rate over the life period. Incorporating various interest rate paths will prohibit arbitrage from occurring. Now we'll assume we want to calculate a reopen call option with 2-year expiration of a strike price 100. The underlying is 7% annual bond and it is of 3 years, and we have a figure that is given to us for the first 2 years. And assume risk neutral probability of move is 0.76 in year 1 and 0.60 in year 2. So if probability of up is 0.74, 0.76 in year up, the probability of down automatically become 1 minus that price, and so on for the second year. Now at the end of 2 years, we could have a different interest rate which is given to us, and we have got all these different interest rate. This is again given to us. Now let's understand how to do this. Now in the middle of the node 2, the price of the bond is given to us as 98.56, and that's something that's given to us. In the middle of the node 2, the price of the bond is 102.62, and this is from the backward induction methodology. So you have the interest rate and you have the future payment at the third year, that's 100. So you'll use future value, you'll use all these interest rate that's given to us to find out the present value. So at the top of the bond and at the bottom, so every place you calculate. So on the top side where you have 6.34, or sorry, on the middle where you have 6.34, it comes to be 100.62. At the top where you have the interest rate as the 8.56, and at the interest rate where 4.70. So once you do that, you can bring all those prices down. So once you have prices for the year 2, then you will bring them down to two interest rate that's given to you. One is 5.99, another is 4.44. And when you bring both of them down, actually you'll then land up to two prices, and these are the two prices that you have to multiply with the respective probabilities. So when you do that, you get a price of 105.01. So as shown here, the price at a given node is the expected discount value of the cash flow associated times the bottom. The discount rate that's applied prevailing interest rate is given node. Note that since this is open option, you only need to bond price at maturity, and if you arbitrage strategy, however, good practice to compute all bond prices. Determine the intrinsic value of option for maturity at each node. For example, the intrinsic value at option at the bottom node after 2 years is 2.20. And this is what we bought everything down to the two prices, and then we had those two prices which we bought down by 5.9% and 4.4%, and we bought it down, and if we take average of them, then we would be landing at the same 100 or 2.20. So after the end of 1 year, the price would be $2. Now, using backward integration, calculate the option value at each node prior to for 1 year. So the option price is 0.03, and this is for each of these nodes. So for example, at the top node, the option price is 0.3, where you have 62% probability of moving up. But if you move up, your option pricing is 0, so your probability of moving down is going to use on the top one. So you can actually calculate the pricing of all of these instruments. Now you just saw that we just calculated the price of bond today, that was 105.01, and the option value then is to be calculated, which has to be discounted of both of these two notes at an interest rate of 3% to calculate the price of 1.45. So first you will calculate the bond pricing of this interest rate curve, and then when you have calculated the bond pricing, and then you have to discount it using the discount rates. What you have to assume is that whenever the price falls 0 on those nodes, you have to take the price of that option as 0. So that's something that you have to make sure. Now we did not knew the bond pricing, and the bond pricing is 105 today, and the bond pricing could be anything in the future, and we'll calculate those pricing at different points and we'll bring them today. So that's how we did it. Now we move to the non-combining trees. Describe the rationale behind the use of non-combining trees in option pricing. The previous example, the interest rate in the middle node of the period was same as 6.34 regardless of the fourth being taken. It may be the case practical setting the upbound scenarios may use a different rate. This example, the tree must have an interest rate above 3% may cause the fixed income point, but any interest rate below to a place would move it to another amount. So when rates move in this fashion, the movement is known as state dependent volatility and results in non-combining trees. From an economic standpoint, non-combining trees are appropriate, however prices can be difficult to calculate using simple ways. Now we move to the next topic, and again you have to be careful in this, and that is constant maturity treasury swap. So calculate the value of constant maturity treasury swap given an interest rate tree and a risk neutral probability. So in addition to value an option with binomial tree, we can evaluate value of derivative instruments such as swap and constant maturity swap. A constant maturity swap is to swap floating rate for a treasury rate such as 10 years. Now let's look at it. Example, assume that you want to value a constant maturity swap. The swap pays you the following interest until maturity, and they have given you the interest, that is YCMT is semi-annual compounded yield for predetermined maturity at the time of payment. YTM is equal to 6 months stop rate. Assuming that there is 76% risk neutral probability of an increase of the spot rate and 60% probability of an increase in 1 year. So we are being given again the same kind of probabilities for 6 months and 1 year, and now we have to value this instrument. The current swap rate is 7%, and whatever be the swap rate after a few years, and we have to adjust that. If you see the diagram closely and you look at the payoff, so the payoff of 1 up and payoff of 1 down, and payoff of 2 up and payoff of 2 down. So the payoff of 1 here is 7.25 minus 7%. So you will write all those payoffs. So payoff of 1 up is 1250. Similarly, payoff of 1 down is minus 1250. Similarly, 1 year top period payoff we'll calculate, and when we'll have all those payoff intact for these interest rate that are given to us, and the interest rate are already given to us as different. And now when we have all these payoffs, we now need to bring this payoff respectively. So for the all possible prices in 6 months are given under risk neutral probabilities plus 6 months payoff. Now if we look at 6 month values from top and bottom nodes, we have to bring all of them today, and that would be the swap price at each timing. So we have given probabilities, so 2500 into 0.6, and the swap price is 0 for the middle path after 1 year, so we have to bring it by 0.4, and plus the swap price that's already being there on that point, that is after 6 months. So you have to not just bring the future price of the swap, but the price that's there on that day, the money that you are going to add, you have to add that. So you will get the price which is the future discounted versus the current money that you are going to get if swap is executed at that moment. When you use both of them, you will get a 6 month swap pricing, the total pricing, and when you have the total pricing, you have to bring it back to 1 year under the two different probability assumptions. So this is how we can value the swap. The only thing different in the example, in this example from the different last example, was that while you bring it down, you have another money that you are going to get due to swap. The next thing is time step. Describe the advantage and disadvantage of reducing the size of the time stack on pricing of derivatives on fixed income. For the sake of simplicity, in previous example we assumed 6 months. However, in reality the time between steps would be much smaller. As you can imagine, the smaller the time step, the more complicated trees and calculation become. Using daily steps will greatly enhance the accuracy of model, but at the expense of additional computer's complexity. Now, fixed income securities and Black-Scholes Merton model. You can get a theoretical question on this, so be careful about this. Explain why Black-Scholes Merton model used in valuing equity is not appropriate to value derivatives of fixed income securities. The Black-Scholes model is well known for equity option pricing. Unfortunately, it's based on 3 assumptions that does not apply on fixed income. The assumption 1, the model main shortcoming is that assume that there is no upper limit to the price of the underlying asset. However, bond price do have a maximum value. The upper limit of bond price when interest rate 0, so that 0 coupon are priced at par. The coupon are priced at the sum of coupon plus par. Now it assumes that the risk-free rate is constant. However, change in the short-term rates do occur, and these changes cause rate along the yield curve to change. It assumes bond price volatility is constant with bond price per se. However, bond price volatility changes over time. Now bonds with embedded option. We have 2 types, callable and puttable. So a call option gives the issuer the right to buy back the bond after 1 or more period in time. And if you can see the yield and the callable bond, the convexity changes after some time because we have a fixed fall, and that sets up a maxima. So for an option free non-callable bond, the prices fall, but the decline in a callable bond will reach a point where the rate is the price of the callable bond will start slowing and eventually level off. This is known as negative convex. Such behavior is due to the fact that issuer has the right to retire the bond prior to maturity of some specified call price. The call price effective holds down the price of the bond and cause the price yield curve to flatten. The point where curve starts to flatten, and note that the remaining yield curve, that is Y prime, behaves like an option free non-callable issue and extreme positive callability. Now below, the investor began to anticipate, below Y prime, the investor began to anticipate that they are going to call this bond back. Therefore, as the yield price of the bond market value is from the above call price, thus callability effectively caps the investor capital gains as yields fall. Moreover, the exacerbate reinvestment risk increases the cash flow that must be reinvested at lower rate. Now puttable bond. The put feature of the puttable bond is a type of embedded option. The puttable feature gives the bondholder to sell the price to the bond issuer at the set price. The bondholder can put the bond to the issuer. The impact of the put feature on the price yield curve is that the price of the put option will be higher, because as you get the money, as you see that the bonds are becoming cheaper, you can still sell him back. So as the yield level relative to coupon rate at low yield level, the price yield relationship of puttable non-puttable is similar. However, when the yield rises above I prime, the price of puttable bond does not fall as rapidly as price of option free bond. This is because put price serve as the floor of the price of the bond. So that was it. I understand that you might get some problem in the numerical part. Just go through once again one of them and let me know if you need help. Thank you for listening. Okay, we now move to the evolution of short-term rates and the shape of the term structure. The topic discusses how decision tree framework is used to estimate price and returns of zero coupon bond. This decision tree framework illustrates how interest rate expectation determines shape of the yield curve. We should understand how spot rates and forward rates are determined by expectation and the risk premium of short rate. Furthermore, the use of Jensen's inequality should be understood, and how maturity and volatility increase the convexity of zero coupon bond. Now let's understand the role of expectation in depending the smart term of interest. Expectation of future interest rate are based on uncertainty. For example, an investor may expect that interest rate over the next period will be 8%. However, this investor may realize that there is also high probability that it could go to 7 or 9% over the next period. Expectation play important role in determining the shape of the yield curve and can be illustrated by examining yield curves that are flat, upward sloping and downward sloping. In the following example that we are going to now look at, the yield curve, future interest rate are known and no uncertainty in the rates. So the price of the zero coupon bond, the price of the 2-year zero coupon bond, the price of the 3-year zero coupon bond, where we assume 8% interest, and this is the 8% interest. But if now suppose 1 year interest rate will remain at 8%, but the investor expects 1 year interest rate in 1 year will be 10%, then the price of 2-year coupon bond will be something different. Now cross multiplying, take into account square root and subtracting, and then we can calculate the price, the forward price. So the 2-year spot price would be something different based on the forward rate. So this is just the conversion of forward and the futures. So 1 year spot rates for the next 3 years, then we'll have the upward sloping curve with 1 to 3 year spot rates. The expected future spot rates will determine the upward sloping of the yield curve. Downward sloping yield curve, it is the same, where you will convert everything into the present price. Let's look at interest rate volatility. Apply risk neutral interest rate trees to assess the effect of volatility on the shape of the term structure. Suppose an investor is risk neutral and has uncertainty regarding expectation of future, and he has to take a decision. Now if there is 50% probability that 1 year interest will grow by 10 and 20%, and 1 year that it will grow by 6%, the expected 1 year can be calculated as 0.5 into 10% and 0.5 into 6%, that's 8%. So that's the joint probability. So we'll have a joint probability of different scenarios that we could see. So the tree is built up of joint probabilities. Now assuming risk neutral, the decision tree in figure 2 illustrate the calculation of prices of 2-year coupon bond with face value of 1 using the expected rate given in the figure 1 decision tree. The expected price in 1 year for the upper node is then calculated, and the expected price in 1 year upper node is then calculated as 1 by 1.1. So the risk neutral decision tree for a 2-year coupon bond. So we know that after 2 years it's going to be 1%, and we have the other values with us, which is 0.909, and let's understand how that works. So there are two things added here. One thing is the expected rate, and you will see that when we multiply the probabilities with the interest rate that's given to us. So after 1 year we can have interest rate of 10% on 6%, each has probability of 50%, or after 2 years we have interest rate of 12, 8, 5, and they have 25, 50 and 25% probabilities. Now based on that we can calculate the expected interest rate, and that is 8% after 1 year and 8% after 2 years. When we use this interest rate and then we bring down the values, so for example we bring down the values of $1 on the top side of the tree using 12%, and when we do the same for them, so when we bring down the values using 12% and add it and bring down with 8% with the respective probabilities of 50-50, then we get the values of after 1 year, and then we bring that everything to today to get 0.85763, which is there. So just observe that all that we are trying to do is to bring this $1 into today's value. So this $1 divided by 1.10 and 1.06, and to bring it down to today for the two values. So when we do that, we get this, and now this is the interest rate that that's something that we believe that it should happen, or this is the price. Now we'll use this price, we'll use the future value, payment is 0, n is 2, and we'll calculate the yield, which comes out to be 7.98. Now this is quite interesting. What we had was a tree, and that tree said that assume 8% today. This might be the current price, and assume movements of 50-50 of these jumps that's given to us. And when we calculated that, we got a price, and when we assume that price to remain constant for the 2 years, we get 7.9%. It's important to understand what 7.98% illustrates. Now when there is an uncertainty regarding expected price, the volatility of the expected rates causes future spot rate to be lower. With the implied rate, we can compute the value of convexity for the 2 years for zero coupon bond, and here it was 8% minus 7.98. So there are chances that the probability of prices that will go down, and therefore we get an interest rate of 7.98%. So now we move to the next example, that's convexity effect. Calculate convexity effect using Jensen's inequality. The convexity effect can be measured by applying a special case of Jensen's inequality, which is expected 1 upon 1 plus r is greater than 1 upon expected 1 plus r. Let's understand this with an example. Assume that the next year there is 50% probability that the 1 year spot rate will be 10% and 50% probability that it will be 6%. And we have to demonstrate Jensen's inequality for a 2 year zero coupon bond rate with a face value of 1%, assuming the previous expectation rate that we just talked about. Now when we do that, we'll use the expected price, the spot rates 10 and 6%, so 1 upon 1 plus r into 0.5, 1 upon 1 plus r, that's divided by 1, and we get a value of 0.92624. The expected price in 1 year with an expected rate of 8%, computing the right hand side, and that would be 1 upon 0.5 into 1.1 and 0.5 into 1.06, that's 92593. Now the left side is greater than the right hand side, and if the current interest rate is 8% and the price of 2 year bond found by dividing the side of equation point by 1 point, in other words, the discounted expected 1 year coupon price for 8% to find 2 years price. The price of 2 year coupon bond on the left hand side of the Jensen's equality is 0.85763, calculated as 0.92624 divided by 128. The right hand side is calculated using 2 year zero coupon bond discount for 2 years at the expected rate of 8%. Now the left hand side is again greater than the right hand side. This demonstrates that the 2 year bond price is greater than the price obtained by discounting $1 face amount by 8% and again 8%. Therefore we know that the 2 year coupon price is higher than the price achieved by discounting at implied discount rate. So it's interesting to see that we assumed 8% implied rate, but we assumed some volatility into that. We assumed that there is a probability of moving up and down, and when we did that and we brought those prices today, and that created and that showed us that the price is different in the future. So compounding on those paths is quite different than compounding it this way. So this is because we assumed that it will go from 8 to 10 and 6, and we did not assume that it will go from 8 to 16 and 0. So our assumption is nearly higher, and that's where it becomes tricky. So although we assumed that it will remain 8% the expected rate, but still when we did all the calculation, we got 7.98%. And this 7.98% showed us that there is 1.84 basis point, and this is the convexity for the 2-year zero coupon bond. And this is the uncertainty regarding expected rates. The volatility of expected rates causes the future spot rates to be lower. And this is again calculated by Jensen's alpha. So what we did was that we bought $1 down, and we bought it down on two paths, versus we bought it down using the formula that we had on the Jensen's inequality. So the 2-year coupon price is higher than the price achieved through constantly discounting in the Jensen's inequality, and this is the convexity effect. Now rising risk neutral decision tree illustrates that although we can assume that 8% over the entire time, and we can move it up and down, but the prices would behave in a very different way. And then similar extension could be done to a 3-year zero coupon bond rate, and we can calculate the decision tree for a 3-year bond rate. So let's look at how that would work. So if we have a 3-year bond rate and we use 8% for the entire time, and we'll get a decision tree. The price of 1-year coupon bond rate in 2 years with face value $1 for upper node is then calculated, and the price of 1-year coupon bond in 2 years. So 1-year coupon bond in 2 years will calculate using the 12%, 8% and 4%. And just observe that the percent that's given on the right hand side, they're not really used. They are just shown so that you get that the expected volatility, sorry, the expected interest rate is 8%, but they're never used. So this 14, 10, 6, 2 is not used. Don't get bogged up by looking at them. So we'll still bring things down by 12%. So we'll bring $1 down by 12%, and by 10% by we'll bring $1 down by 12%, both of them, and we'll bring it down by 8% and by 4%, and those would act as the 3 prices that we got in the future. And then we'll again bring them down on the respective by 10 and 6% with the respective probabilities, and then the price that we get, we'll bring it down by 8%. So just observe that when I was bringing these things down, I did not use the last shown interest rate, so that does not comes into play here. So when we bring it down in this way, we have ignored a lot of other things here. So when we bring it down, we get 7.9%, which is very different from the 8% that we took, and we got 5 basis points. And if you recall that the value of convexity for 2 year was 1.84%, if all held equal, the value of convexity increases with maturity. So in the other words, the maturity of the bond increases, the price-age relationship become more complex. This convexity is due to volatility. Thus, if we say that the value of convexity increases with volatility, and the risk neutral probabilities still leads us with the same way. So risk neutral decision tree illustrating effective probability. Now if we use remember we use 8 to 10 and 6. If we use 11 and 5, the interest rate would be very different, and the 2-year implied post would become higher. This is higher because the 2-year example, the convexity of 1 4, expected spot rates were 4 to 12, instead of 2 to 14. Thus the value of convexity increases with both volatility and time to maturity, and this is really the takeaway point here. So all what we did was that we were using that expected rate that was 8%, and then we tried to draw those paths, and what we found that as we keep on broadening those paths, the convexity was increasing. It was increasing with time as well as the paths that we were taking. So that's how we would be working on them. Let's move to the next topic, that's risk premia. Also the last topic of the subject. Calculate the price and the return of zero coupon bond incorporating a risk premia. Suppose an investor invests 1 year rates which resemble close to like 8, 10, 8% increasing to 10 and 16 and 12, 8, 4. And there is a volatility of 400 basis point of the rates for 1 year, where we use the exactly same one, and next year. Then the risk neutral investor calculates the price of 2-year coupon bond, and it's the same way as we did it. And for example, the price is 0.85763, implied a 1 year expected return of 8%. However, this is only the average return. The actual return will be either 6% or 10%. Risk averse investor would require higher rate for this investment than an investment that has certain 8% with no variability. Thus, risk averse investor requires a premium for bearing this interest and demand a return greater than 8% for buying a 2% bond and holding it for 2 years. Now, incorporating risk premia, calculate a price and return for a zero coupon bond using expected return and assume a risk premium of 30 basis point for each year. So let's look at it. So the price of 2-year bond with 30 basis point risk premia included. Now we are going to do that by 1 upon 1.03. So we have used 10.3 and 6.3, and we'll bring it down, both of them, to today's price. And when we do that, we get 85525. Note this price is less than 85735 price calculated for the risk neutral investor. Next year the price of 2 year will either be 0.9 or 9430, depending on whether 1 year interest rate is either 10% or 6%. Thus expected value for the next 2 years for the bond is again calculated as bringing those two prices down to today's value. But what we'll do here is that we'll subtract the price, both of these prices, and divide it by the 85525, the price that we got. So the risk investor require a 30 basis point would require 8.3% return to compensate for the interest rate risk. For a 3-year bond, risk averse would require 8.6 return to the 2-year interest rate risk. So if nothing was happening and we started with the earlier case where everything was remaining 8% and we were doing all those calculations, and suddenly he said that the 10% and the 6% has a moment of 3% up. So we just added those 30 basis point to the 10% and the 6%, and we did nothing else. So we just subtracted those prices and divided both of them for his prices to calculate the money that he wants today. So that become 8.3% for 1 year interest rate risk. The risk premia that we use, we added them with 10% and 6%, and we brought things down. So we are using an upside of risk premia. So as the name suggests, premium, we have to add them to the 10% and 6% assumption, and then bring everything down to find out the value, and then subtract the value from the normal case where we assume the same risk neutral probability. So that was it for this question. There are high chances that you'll get a numerical on this, so be prepared to do that. I hope this lecture added something to your current knowledge base, and yes, I understand that you need to have the book with you while listening to this. Anyways, thank you for listening, and have a nice time ahead. Okay, I'll now talk about the art of term structure models. The topic introduces different term structure models for estimating short-term interest rate. We'll discuss models that have no drift, constant drift, time deterministic, and mean reverting. We need to understand the difference between these models and know how to construct a two-period interest rate model prediction. Limitation of each model, impact model, and effectiveness. Now, for the Vasicek model, we have to understand how to convert a non-recombining tree into a combining tree. So describe the process and effectiveness of the following models and construct a tree for a short term using a model with normally distributed rates and no drift, a model incorporating drift. Now, term models with no drift, the topic begins with the simplest model for predicting evolution rates, which causes that there is no drift and interest rate are normally distributed. The continuous compounding interest rate will be dr is equal to change in interest rate into sigma into dw, where dw is nomination with mean 0 and standard deviation root t, and annual point basis volatility change is sigma, and dt is the small change in interval. So given the definition, we can build up an interest tree using a binomial model. The probability up and down will be the same for the period. 50% or 50% down the tree will be recombining. Since the tree is recombining, the up-down path end up at the same place. For example, assume the short-term interest rate is 6% and volatility be 120 bps. Using the above notion, R naught is equal to 6%, volatility is 1.2%, dt is equal to 1 by 2, dw has a mean 0 and standard deviation of 1 by root 2.2278. After 1 month, we assume a random dw takes a value of 2 drawn from a normal distribution with mean 0 and standard deviation 0.2287. Therefore, the change in interest rate over the 1 month is calculated as 1.20, that's dr, into 0.2, that's 0.24, and 24 basis point. So this dw comes from a normal distribution, and we keep every point and calculate. So that would be 6 plus 0.24. So in the model one, we expected the dw is 0, the drift is 0, and the standard deviation of dw is root dt. The rate of volatility change is sigma root of dt. Now we need to understand here that the short-term interest rate and standard deviation and the change of model is normally distributed, and we have assumed no drift. So in that case, 1.2% was a standard deviation, 1 by root 12 was the time period, that was 1 month, and it was 34.6 basis point. So we did not multiply anything with the pick from the normal distribution or the draw from the normal distribution. So what we can see is that when we move ahead, and the tree with no drift would be r plus sigma root of dt, r minus sigma root of dt, r plus 2 sigma dt, r and r minus 2 sigma dt. Now interest rate with previous numerical model, 1 period from now observed, will either increase by 50% or either it will decrease by 50%. Now we just calculated that 34.6 is the basis point, but this was the mean that we calculated, so we did not multiply anything like any random drawn thing from it now. So we just calculated sigma dt, subtracted sigma dt, and again we did that, r plus 2 sigma dt, now minus 2 sigma dt. So that is how the tree would look like. Now moving ahead, describe the method for handling negative short-term interest rate for term structure models. Note that the terminal nodes of the two-period model generate 3 possible rates. That is r plus 2 sigma dt, r naught, and r minus 2 sigma dt. The discrete finite set of outcome does not technically represent a normal distribution. However, knowledge of probability distribution tells us that the number of step increases, terminal value will approach a continuous normal distribution. The obvious drawback to model 1 is that there is always positive probability that the rate could become negative. On the surface, interest rate do not make a much economic sense. A lending of 100 and receiving of 100 in the future. However, you could probably rationalize a small negative interest rate safely or convenience holding cash for sufficiently high. The negative interest rate will be exacerbated as the investment horizon get longer, since it's more likely. So assuming a 10-year horizon, standard deviation of 1.2 root 10 and 3.79%, clearly a negative interest rate that will be well within 2 standard deviation. Now Also note that the problem of negative is greater when the current level of rate is 4%. There are two reasonable solutions to negativeness. First, we could use distributions that are always non-negative, such as log normal or chi-square. In this way, the interest rate can negative, but the action may introduce a non-desirable characteristic called as skewness or inappropriate volatility. Second, the interest rate can force negative interest rate to take a value of 0. This way the original rate adjusted to consider the distribution. This method may be preferred to, and I remember this thing when we simulate EV by EBITDA. The stock prices can also not go negative, so EV by EBITDA can also not technically go by negative. So we block it to 0, but we don't take a negative value. Now, as one final note, is ultimately up to the user to design the appropriate for the matter. For example, if the purpose of the is to price coupon paying bond, the valuation is closely tied to average interest rate over the time. If the possible effect of negative interest rate is less important. On the other hand, option valuation that have asymmetric payoffs that will be more affected by negative interest rate problem. Model 1 effectiveness. Given that no drift assumption, model 1, we can draw several conclusions regarding the effectiveness of the model. The no drift assumption does not give flexibility to accurately model basic term shape. The resulting is a downward only predicted term due to larger convexity effect. Recall the convexity difference between the model per yield, its assumed volatility, and the per yield and the structure model using zero volatility. Model 1 predicts the term structure which is flat, whereas the observed is a hump shape, rising and falling. Model 1 has only one factor, one short-term rate. Other models may incorporate factors like drift, time-dependent volatility from a richer set of prediction. Model 1 implies that change in short-term rate would lead to parallel shift in yield curve. Again, a finding incongruous and observed yield curve shift. Now, term struct model with drift. Now, we'll add a drift parameter to the same thing. So, casual term struct module typically reveal an upward sloping curve which is odd at model 1, which does not incorporate drift. A natural extension to model 1 is to add a positive drift that would be economic and present positive risk premia with longer time horizon. We can augment model with a constant drift term which is lambda dt. And let's continue with a new example, and we say that the R0 is 5%, lambda is drift which is 0.24%, standard is 1.5%. Then DW realized drawn from a normal distribution is having a mean of 0 and standard deviation of 0.2287 is 2%. It's 0.2, sorry. Thus the change would be 0.24, that's drift, and 1 by 12 into DW, which is 1.5 into 0.2, so that's 0.32%. That's the 1 month drift. So lambda, we just calculated that DW was 0.2. If you remember how we did that. So we said that the mean is 0, the standard deviation is 0.2287, and the DW realizes from normal distribution, and that this 0.2 is a random number that we get. So otherwise, if we don't take such a random number, then we'll get just the drift term and not the disturbance term. So disturbance terms. So this 0.2 could be anything. So don't worry about this 0.2 here. So this 0.2 could be 0.3, could be 0.4, could be 0.6, could be anything. So the actual rate would be 1.5%, the standard deviation into a randomly drawn thing, and that becomes 0.2. So that's how we did it. And if this standard deviation is we have not currently corrected it with the root t thing, so just be careful about that. So we directly got dw, and we did not use standard deviation into root of t, and we did not do all that calculations for now. But the monthly drift is 0.24 into 1 by 12, and the standard deviation that was 1.5 into 1 by root 2, 1 by root 2, and 0.43 or 43 basis point per month, and 2 bps drift represent any combination of expected change and risk premium. So that's how we did it. For example, a 2 bps shift could lead a drift of 1 bp change in coupled with 0.1 bp risk premium. So the interest rate model will look like R0 plus lambda dt plus sigma under root dt, and this is a model with the drift. Now this is something that we are going to see again in the counterparty risk, where we'll look at different types of models that we can use to value different types of collateral that could be seen there. So just keep these things in mind. Now when we move ahead and we look at model 2 effectiveness, we have added a drift parameter. The only thing that you should be concerned about is the monthly drift, because it's sorry, the standard deviation term, which is if you are given a standard deviation 1 and you have to make it into 1 by root t, so 1 by root 12, so 43 basis point. So just be careful about that. Now model 2 effectiveness, as you would expect, model 1 is little more effective than model 2. Intuitively, the drift term can accommodate the observer upward sloping nature of the term structure. In practice, a researcher is likely to choose R and order based on calibration of observed rates. However, term structure will fit better. The downside side of the approach is that estimated value of drift could be relatively high, especially if considered a risk premium only. On the other hand, if the drift is used as a combination of risk premium and the expected rate change, the model suggests that expected rates in year 10 will be higher than year 9. In an appropriate short term, this is more difficult to justify, as an increased expected rate is in the long term. Now we have the Holy model and we'll look at what does it say. Holy model further generalized the drift to incorporate time dependency. That is, drift in time I may be different and drift in time 2. Additionally, each drift does not have to increase and can be negative. Thus, the model is more flexible than the constant drift model. Drift is a combination of risk premium over the period and expected rate change. So R0 plus lambda I dt into sigma naught and lambda I plus lambda 2. So lambda, if I is equal to lambda 2, then whole I model reduces to model 2. Should not be surprising that lambda 2 are estimated from market price. In other words, R0 is observed from one spot and lambda 1 is estimated the model require observed 2 period prices. Lambda should be calibrated from R0 and lambda 1 and the observed market rate for time dependent security. So we are adjusting the drift parameters in the Holy model. Now arbitrage free models. Describe uses and benefits of arbitrage free model and assess the issues of fitting models to market prices. Broadly speaking, there are two models, arbitrage free model and equivalent model. The key factor in choosing between the two models is based on the need to match market prices. Arbitrage model are always used to quote the price securities that are illiquid or customized. For example, arbitrage free is constructed to properly price treasury security. So arbitrage free model are used to quote securities that are illiquid or customized. For example, arbitrage tree is constructed to properly price on-the-run treasury security. Model prices must match market price. Then arbitrage tree is used to predict off-the-run treasury securities compared to price if they are properly valued. These arbitrage models are also commonly used for pricing derivatives based on market price on underlying securities, example options on bond. There are two potential detractors of arbitrage free model. First, calibrating to market is still a subject of suitability of original prices. For example, if the parallel shift assumption is not appropriate, then better model like adding drift should still be faulty. Second, arbitrage model assume the underlying prices are accurate. This will not be the case. For example, temporary exogenous shock like oversupply of market due to forced liquidation which temporarily depress the market prices. If the purpose of the model is relative analysis comparing value of one security with an arbitrage free model which assumes both security or problem size is meaningless. Hence, for relative analysis, equilibrium models would be used rather than arbitrage free models. Now we move to Vasicek model, Vasicek. Describe the process and construct simple and recombining train for short term using Vasicek model with mean reversion. So this Vasicek model assumes a mean reverting process for short term interest rate. The underlying assumption is that the economy has an equilibrium level of economic fundamentals such as long term monetary supply, technological innovation and similar factors. Therefore, if the short term rates are above the long term equilibrium price, then the drift will be negative to bring the rate closer to its mean reverting value. Similarly, short term rate below the rate will have a positive drift adjustment. Now what we do here is we add a drift parameter, and a drift parameter has K, a parameter that measures speed of reversion, theta naught which is the long term assuming risk neutrality, R which is the current rate, the difference into K plus and this is the drift into sigma dw. So the K measures the speed of the reversal admission. It's kind of a slope. The high K will produce larger adjustment, small K will be smaller. The larger differential between the long run and the current rate will produce a larger adjustment in the current period. Similar to previous discussion, lambda is a combination of expected rate change in premium. The risk neutrality assumption of long term value of the short term is sigma is equal to R1 plus lambda by K, where RL is the long term to interest rate. So under the consideration, and if we look at numerical example, suppose the revision estimated parameter is 0.3, annual standard deviation is 150 basis point, true run long term interest is 6%, current interest rate is 6.2%, annual drift is 0.3%. Then we will calculate theta as R1, which is the long term interest rate, plus lambda, which is the annual drift, and divided by K. So K is okay. If you look at it in a different way, it should be theta, which is your long term interest rate, and you'll minus that with R1, and you will divide the lambda, which is your standard deviation. So it's nearly the same ways on how to put it. So reversing it, we can calculate the long term interest rate, and in some of the time it may look weird, but the long run value of a short term rate, it's just a mathematical number, so don't worry if you get a 20 or 25%. That's just used to in fact change the prices of this as well. So that would be K into theta minus R, which is the current interest rate, into dt, that's 1 by 12, and that would be your TR. Assuming and if you add the volatility parameter, then you will add another 43 basis point. So the first upper node would be calculated in the similar way, where you will calculate this and you will add the other part to it. So this is just the disturbance. You have to keep adding this disturbance to the last term. Just remember that part. So again I am repeating, theta is equal to R1 plus lambda K1, or theta minus R1 is equal to lambda upon K, or K is equal to lambda upon theta minus R1. So K adjustment factor is the number of lambdas or standard deviation that you have to use, so to get it close to the mean reverting. So that's your K parameter, or in other words your K parameter, if your lambda is higher, then your K parameter is higher. So that's how you do it. Okay, we now move to the next part. So if the interest rate evolve upward, we would then turn to the upper node, and if the interest rate evolves downward, we would turn to a lower node in the second period. So this all would also depend on where we are moving. So once we are on one step, we'll see that a mean reversion would happen. Okay, so the final step for recombining the trees is to solve for the P and the Q, which is RUU and RDD, where PU are respective probabilities in the trees for the second period after the up and down movement. We can solve the unknown parameters using the interest rate that we have of the future to find out these probabilities, and we can do this process iteratively. Let's look at the next topic here. Calculate the Vasicek model rate changes, standard deviation of change of rate, and expected TS and half-life. In the previous discussion, emphasized the rate of change in Vasicek model and the computation of the standard deviation when solving for parameters in the recombining trees. In the section, we'll look at how to forecast this for T years. To continue with the previous example, the current rate was 6.2 plus mean reversion parameter of 0.03. The long-term mean reversion level will eventually reach 18%, but this will take a long time since K is quite small. Specifically, current rate of 6.2 is 11.8 from the ultimate natural difference will be decay exponentially at a mean reversion rate. To forecast 10 years, we will use 11.8 into e to the power 0.3 into 10, which is 8.74%. Therefore, the expected rate in 10 years would be 18 minus 8.7%, 9.26%. In the Vasicek model, the expected rate in T years can be represented as the weighted average between the current rate and the long-term horizon value. And the weighted factor for short-term decay exponentially by spread of the mean reverting parameter. If you remember, in technical instances, we have the exponentially weighted EWMA average prices, something like that. So we are using an weighting factor, and we are using that weighting factor. Okay, let's understand this one. So a more intuitive measure for computing T or the forward rate in T years is using a factor half-life, which measures the number of years to close half the distance between starting rate and the mean reversion. So this is again a similar measure that that's used in the nucleus decay, again borrowed from physics. So a larger mean reversion K will result in a shorter half-life. So just remember this term. You can still ignore the other part here. To describe the effectiveness of Vasicek model, there are some general comments that we make to compare for mean reverting model without mean reverting. In development of mean reverting model, R0 and theta are not well calibrated to match the observed market prices. Hence, mean reversion parameter not only improves the specific of the term structure but also produces a specific term structure of volatility. Specifically, Vasicek model will produce a term structure of volatility that is declining. Therefore, a short-term volatility is overstated and the long-term is understated. To contrast, model 1 with no drift generates a flat volatility across all maturities. Furthermore, an upward shift in short-term interest rate in the mean reverting model will be impacted more than long-term rates. Therefore, the Vasicek model does not imply a parallel shift from exogenous liquidity stocks. Another interpretation concerning the nature of the shock. If the shock is based on the short-term economic views, then the mean reversion model implies that the shock dissipates as it approaches the long run. The larger the mean reversion parameter, the quicker the economical news is incorporated. Similarly, the smaller the mean reversion parameter, it takes longer for the economic news to assimilate into security prices. As in this case, the economic news is long-lived. In contrast, shock to the market with drift affect all rates equally regardless of maturity and produces a parallel shift. So try to compare some of the things here, and let's look at some of the questions. So questions could be based on the shifts that we assume on the Vasicek model on model 1 and model 2. So Vasicek model implies decreasing volatility and non-parametric shift which ages in short term. Hooley is actually more general than model 2. The no drift and constant drift are special cases of Hooley model. Okay, the other questions that you could be asked would be actually to guess a Vasicek model. Just remember that you have to use K and subtract the long-term average from the current and add that 1 by root T into the standard deviation. The economic news is most likely short-term in nature, therefore mean reverting model parameter is high so that the mean reversion adjustment period will be relatively large. Okay, then we can have questions of numerical 1 and of type 1 and type 2 that you could see. So that was it for here. The next part would be the art of term structure model, volatility and distribution. So there are two things that I would like to revise before we end here. First was the long term mean was R1 plus lambda upon K. So R1 is the interest rate, lambda and K, and that would be the theta. So that's a best guess for R theta. So theta is equal to R1 plus lambda upon K. And the expected rate in T years can be forecasted assuming exponential decay of difference level. The half-life tau can be computed as time to move halfway, and it is theta minus R0 e to the power kt is equal to half theta minus R0. So this will help us to calculate K, because we know if we assume some theta, if we assume some R0, we can calculate the K, or we can calculate the half-life as well if we have got K with us. So that would do it for this session. Thank you for listening. I hope it added something to your current knowledge base. Okay, so we'll start with the Cox, Ingress, Ross model and log normal method. Now as we looked at the Cox ingress Ross model, we saw that the DRS or the change in interest rate was K into theta minus R dt plus sigma into R of dW. The change here is the root R, which is sticking to sigma, and we said that the volatility increases proportional to the square root of the rate. So if we are at a high point in time, then the volatility is going to be high. So this is a change with the earlier model, and we are looking at the Cox Ingersoll Ross model. The second, there are few misspecification with these models that could jump into. A common misspecification of model where basis point volatility increases with the short-term rate as log normal model. So an important property of the log normal is the yield volatility sigma is constant, but the basis volatility increases with the level of short-term rate. Specifically, basis point volatility is equal to sigma r, and the function where sigma is constant and dr increases as sigma r. So both Cox Ingersoll model and log normal, as long and short term interest is not negative, then positive implied that the short term interest rate cannot be negative. So as discussed previously, this is certain a positive feature of the model, but it actually may not be that important. For example, if a market maker feels that the interest rate will be fairly flat and the possible of negative interest will be only margin, then the market maker may opt for simpler constant volatility model rather than more complex Cox Ingersoll model. The difference between the two distribution of short-term rate for normal Cox Ingersoll and log normal is always important to analyze. Now if we look at a figure which shows the distribution after 10 years assuming equal and standard deviation, so normal distribution will apply positive probability of negative interest rate. In addition, the longer forecast period, the greater likelihood of negative. This can be seen on the left tail of a normal distribution, but this would not be there in the Cox Ingersoll model, and this would not be there in the log normal model. So in the log normal model and in the Cox Ingersoll model, volatility would not go to negative. So in contrast to the normal, the log normal are always non-negative and skewed to right. This is important pricing information, particularly for out of the money options where the mass of the distribution can differ dramatically. Now let's look at the application of log normal model with deterministic drift and log normal model with mean reversion. Now for this we have to look at two log normal models, one with deterministic drift and another with mean reversion. The log normal with drift would be and we'll look at d into and log of r is equal to at into dt plus sigma into dw. The natural log of the short term rate follow normal distribution and can be used to construct interest rate curve. So we'll take log normal and we'll solve it, and then also we can take the exponential. So I'll directly move to the exponential way of expressing the same. So in the exponential way of expressing the same, you will see that r into e into a1 dt into sigma root dt. So everything remains as it is. The drift parameters is the current interest rate, and the other parameters sigma dt remains as it is, and we'll use e to the power this. So e to the power this entire term would be used. Now if you remember in the earlier model from where we started it, and the very simple model of the drift or the very simple model R0, we again used R0 into theta t, and then we added a drift parameters and drift into dt. So the drift was again mentioned in a special way by lambda, but here the drift is a1 into dt, and a is representing drift here. So when we use the log normal with mean reversion, then the equation would be incorporating log of theta t minus log of r and kt and sigma t dw, or in the exponential part we'll use k of 1 and the log of theta 1 and log of r naught. So the same goes in the exponential model. So in contrast to Holy model where drift term is additive, the drift term in the log normal are multiplicative. The implication is that all rates in the tree will always be positive. Furthermore, and that's also because e to the power x is greater than 0. Furthermore, e to the power x is equal to 1 plus x if we assume a1 is equal to 0 and dt is equal to 1. Hence the volatility is the percent of the rate. For example, if volatility is 20%, then the upper node will be 20% above the current short-term rate. Okay, then we have the log normal model with mean reversion, something that we just talked about. So the natural log of the short-term rate follow normal distribution and it will revert to the long-term mean log theta t, and adjustment parameter would be kt. In addition, volatility is time dependent, transferring the Vasicek model into a time varying model. The interest rate tree is based on this model is a bit complicated but exhibits the same basic characteristic. So it should be e into k to the power log of theta minus log of r into dt into sigma into root dt. So that's how we do it. So we'll have upper node and the down node as always. So if we recall from the previous session that in mean reverting model the nodes are forced to recombine by changing the probability of the second period to properly value the weighted average path in the next phase. Similar adjustment can be made on the model. However, the adjustment varies length and time dependent by multiplicative factor dt. After choosing dt1 and dt2 is determined by the equation. So that was it, a little bit of overkill kind of a topic, but let's look at some of the questions. So let's look at the Black-Karnasiki model. And for the Black-Karnasiki model, feature of time varying mean reverting log normal model is that it will not recombine naturally. Rather, time intervals between interest rates are recalibrated to force the nodes to recombine. The generic model makes no prediction on the speed of the mean reversion adjustment. So that's a Black-Karnasiki model. Now, Holy model with drift is very flexible, allow drift terms in each period to vary, hence cumulative effect is additive. In contrast, log normal model with drift allows the drift to vary, but the cumulative effect is multiplicative. Just remember the log normal thing, the cumulative effect is multiplicative and it's also non-negative. So what are the advantages of Cox and Cross model? The advantages are interest rate are always non-negative and the basis point volatility increases during high inflation period. So that was an advantage. The out of the money price may differ with the use of log normal distribution. So basis point volatility and yield volatility. So basis point volatility under the CR model increases with a decreasing rate, whereas basis point volatility under the log normal increases linearly. Therefore, the basis point volatility is a linear function for both models, and this is interesting. So, if you remember for the log normal model, and we multiplied it, the volatility e to the power lambda dt. So, if as time increases, we are increasing the volatility. Whereas in the Cox and Cross model, with volatility we were using root r. So the basis point volatility increases proportional to the square root of the rate. So that's how things work. So the volatility of the CIR increases at a decreasing rate, whereas basis point volatility under log normal increases linearly, and that's how they are different. So it's quite interesting because this volatility in the future with the interest rate could increase or it could decrease. So that was it for this chapter. A quick revision of Cox and Cross model and volatility model. So Cox and Cross model has mean reverting as a constant volatility and a basis point volatility of uh, sigma into root r that increases at a decreasing rate. The two log normal are with deterministic drift and mean reversion. In the deterministic drift, it's 80 into dt plus sigma into dw, which is very similar to Holy model with an additive drift. Only the thing is that we use log r, d of log r. And in the interest rate and in the drift model, we use theta minus r, but we take a log. Kt is kept out of log, and theta t and dw are as it is. The model does not produce a recombining interest rate tree. In order to force the tree recombine steps, dt must be recalibrated. So that was it for this video. I hope this was helpful to you and added something to your current knowledge base. Thank you for listening.